Hi, I'm Brett Hickey, founder and CEO of Starmount Capital. Excited to be here today with Dylan Tate, the Chief Investment Officer of New York State Pension Plan. Dylan, thanks for joining us.
Thanks for having me.
So let's talk a little bit about your views on the economic environment today, how you're thinking about the economy, and as you think about the economy, what appeals to you about private credit as an asset class? How do you think about that from a risk-return defensive nature?
So, the economy, I think, is in a pretty questionable spot right now. I think we can all agree on that. And, we haven't been overweight equities. We've been kind of taking risk off the table where we can, and debatable whether that's been the right move or not. But if you look at where interest rates are, obviously the consumer's been strong, but credit card debt levels are approaching astronomical values. And if you think about all that, I think it's best to say that the economy is just in a questionable state at best. So if we think about where we want to be in that type of environment and where's the best risk-adjusted returns for us, we really think private credit's a good spot to be. And that's because if you think about where you want to be in the capital structure in a questionable economy, right? It's in the senior secured part. You want to be away from equities, and you also want, tight covenant packages if you can get them. And, like many other plans, we need an 8% return, so we can't park our money in treasury. So if we're finding the right firms that can find these types of loans, and they can get us low double digits, even low teens returns in a senior secured part of the market, we think that's a really attractive spot to be.
Yeah, I'm of course biased, but I agree. I think the one thing that everybody can agree on is we don't know what the world will look like over the next 6, 12, 24 months, and having some positions that are more defensive in that, especially with the current levels of interest rate. We find curious, how do valuations keep up? Timing public markets is near impossible. I think a lot of hedge funds have proven that for us. And you look at the rates that businesses are paying and how much of their cash income is used to service interest instead of investing in R&D and in growth. And it's similar to the conversations people have about the lag, I think, in monetary tightening, where there's about a 1-year lag until you see that come into the economy. And we feel at Star Mountain similarly with corporations. When you go a few quarters with companies not being able to invest in R&D, not being able to invest in growth as much because they're servicing their cash interest obligations on their debt, it's hard to think about how that doesn't eventually slow growth. How do you guys think about, you mentioned covenants within credit as something. Talk to us a little bit about why covenants matter, what that is. When people think about high yield, you generally don't have much for covenants, if any, broadly syndicated loans. How do you think about covenants? Why are they important to you?
Yeah, so that's a good point. And, another really attractive thing about private credit in this environment, right, is a lot of it is floating rate loan exposure. So as rates have gone up, that's not great for other parts of the economy, but it's been good for our direct lending portfolio. But you do bring up a good point in that it does make, especially where we've kind of focused in the lower middle market, it makes those smaller companies, makes it a lot tougher for them to service their debt. So that's where I think, manager selection and finding people with the right experience, the right teams in place, the right resources to handle maybe bad situations that come forward is just paramount. It's extremely important. So when I think about covenants and the right managers to do that, it has to be people with experience that can negotiate really good credit agreements, that have experience doing that. And, I think if you, in our opinion at least, if you creep into the larger part of the market, then you're going up against very large cap, sophisticated private equity sponsors that are very good at negotiating against you. So we found it's a lot easier to get covenants and good protections in the smaller part of the market. And I think what that allows to happen is it allows the lenders to not only have, more protections and reasons to go back to the table and maybe re-underwrite a loan or reprice it, but it allows them so much more visibility and sort of even control into the loan and, into the company and when things might start going south a little bit. So again, in a questionable environment, I just think that's a great thing to have. It's a great place to be. And the more kind of safety you can get from covenants and, being seen in the capital structure, that's what we're looking for.
Makes sense. At Star Mountain, we like to think about when we're underwriting companies and structuring the covenants, managing the companies, that we are happy to get lucky and nothing goes wrong and the economy continues to grow, but we don't plan on that. We plan that challenges will occur. And I think you're right. Challenges often are harder than people anticipate, more stressful than people anticipate. So making sure that managers have the teams and experience and alignment in place already, so challenges come, they're not scrambling, trying to figure out how to deal with it. Any other things that you think would be some good words of wisdom as you guys are forecasting and cleaning off your crystal ball?
Well, we definitely don't have a crystal ball. No, look, like I said, I think, our job is just it's not to call the markets. It's not to try and have a crystal ball, but, just finding the best risk-adjusted returns we can in these markets is what we're working on. Like I said, I think private credit and direct lending specifically is a pretty attractive spot for us. So
that's great. Well, thanks for joining us.
Thanks for having me.